Mutual Fund and Motilal Oswal AMC. So today we'll be taking a masterclass of all of us, telling us more about ETFs and passive investing. You guys hear me? Sorry, Bill?
Put these lights on. Just put these lights on. So that I can see them. Lunch time, people might have a good nap. Let's put these lights on. That side also. Yeah. You guys can see screen, right? Yeah. You can hear me, right? Yeah. Do I need mic? Good enough. That will help me to keep my hands free. So, first of all, you will have to okay.
You can use the clip-on mic. He'll be walking that side, is the issue.
Okay, so some interesting discussion.
Please don't sit there.
I'd like to begin. How many of you have heard this word? Exchange traded funds. Okay. 1, 2, 3, 4, 5. How many of you invested? 6, 7 euros. Okay. How many of you invested? Okay, I can see only 2 hands this side. Okay. So it's like you have not done your primary. I'm going to talk about post grad. Okay. So this is the topic for today. Let me try and make it very simple for you guys. What ETFs are is all about. I was fortunate to work with the pioneer of ETF and index in India, which was gold, which was actually a benchmark mutual fund. I don't know if you heard gold bees by any chance. Have you heard? Anybody's heard? 50 bees. So gold bees is the gold exchange traded fund. It was the first ETF in India. I launched that in 2007. And after that, we had multiple. So we'll see how the evolution has happened. Okay. So before we go forward, few slides, very basic slides, where let's try to understand styles of investing. And I was talking to Parth. I think every one of you are very keen and very excited to know how investment happens. Okay. So these are the popular 2 types of investments, which is active and passive. So one is active, is basically I am a fund manager. I'll have some analyst. Okay, so here Parth is sitting. Who's next? Your name? Tanjar. Yes. Okay, so these are say my own analysts. What I'll do, I'll give them each of one sector. Okay, so Parth will look at say financial sector. She will look at the cement sector. Okay, he might look at the real estate sector. She might look at steel sector, okay, and so on and so forth. And they will study all the companies in that segment, and they will come and tell me that this is what the valuation looks like. Okay, these are the top 5 ideas out of the listed universe in a particular sectors, and then I will take a call based on my wisdom, my knowledge. Okay, this is how so I'll pick up few companies from here, pick up few companies from here, and I may not pick up anything from her also. That's called active investment. Okay, so the active research plays a role. Whereas there is an objective here is to beat the market. Maybe it's clear. Yeah, aim is to beat the market. Beat the market is the broader indices. We'll see what broader indices are also about. And the second part is the passive investment. Okay, passive is nothing but you don't need these people. Okay, it's not about AI. But you pick up an index and just replicate a portfolio. That's why something called replicate the market. So you don't do active research where you identify stocks and build a portfolio. Whereas there is a ready-made portfolio available, you just replicate it. Okay, basic question. First part and second part. The first part of investing, where do you think where the cost of a manager will be higher? Active, huh? Because I need these 4 guys to do a lot of research. Okay, you need a fund manager who has say 20 years of experience to understand what to pick up, what not to pick up. But when I have to replicate the basket or ready-made portfolio, my cost is definitely low. Okay, so just keep this broadly in mind. We're also gonna dwell more into replicate the market as we go forward. So I'm gonna also talk about give you instances of some of the Nobel laureates, what they talk about passive investing. Okay, what passive investing, passive philosophy is all about, how it is evolved, what role it plays in your client's portfolio, in your portfolio. So briefly, pros and cons. One is when you go for active investing, there is a better return potential. Okay, there is risk management and flexibility of fund manager. Okay, whereas when I replicate a portfolio, I can't do much. But there are cons also. Benchmark hugging, we'll see what benchmark hugging is all about. Style drift, the fund manager may change his style of investing. We'll see that as well. And there are high fees, which we just discussed. Whereas passive is ultra low fees because I don't need bigger team. I have to replicate one existing or available portfolio. What I get is a transparency. I know exactly, you as an investor, you know exactly where you want to invest. Active mutual fund, what happens, there is only a month-end portfolio available. But yes, there are few cons. We'll actually talk about these cons also going forward. No outperformance, sometimes concentration to large stocks, and potential liquidity issues. So, what is benchmark hugging? So there are 3 type of investments. In fact, let's go to the next slide. This is a product pyramid on equity, where how investment happens, how portfolio is designed for active investments or equity investment, not active as such. Okay, so there are 4 parts where your all passive investment, index fund investment will come here, ETFs will come here, so-called active mutual funds come here, and then these are benchmark hugging and alternates, where you actually benchmark agnostic alpha generating strategies and alternates, where you actually striving to generate more returns. Okay, and what comes in there? You must have heard PMS, portfolio management. You must have heard AIFs. Some consonant portfolio actually falls under first 2 categories. What is benchmark hugging? Most of the time, though I have 4 analysts, okay, probably sometimes I have 10 analysts, I have 2 fund managers, and still, what I end up doing is replicate an existing portfolio, which is called nothing but index. We'll see what index is all about. Okay, and my job is to outperform because I'm an active fund manager. But my also a job is not to underperform too much. Now, just give a thought. If I don't have to commit too much of mistake, what I need to do? In investment style, right? If there is a benchmark, there is an index. Okay. If I don't have to underperform, what I need to do? I need to stay very close to that benchmark, right? Close to that my index. That's called benchmark hugging. So what's going to happen? This is actually started happening. Those who need alpha, those who need additional returns, they're actually it should have moved from benchmark hugging. It should have gone upside. So now those who need alpha will actually move from benchmark hugging to upward, and those who want to reduce their costs will actually go from benchmark hugging to passive. So this shift has already started happening. We'll see the reasons why as well. So what's an index? Have you heard about index? Equity index? Any index you guys can name? Nifty 500, S&P 500. Okay, anybody? Sensex. Anything else? Have you guys heard? Nifty 50. Okay. Exactly. So these are nothing but called index. There is one word written here: market wisdom. So you said Sensex, right? So how many stocks Sensex has? 30. This is a question. You can guess also if you can answer. I know if you can guess also, that's also good. How do you think that 30 stock come into that index? Can you slightly louder so that everybody can hear?
The ones which are like the ones which are traded in the highest volume in a certain time period in there. Like the ones who are like the highest capital of where capital went in a certain time period to be the ones that make sense.
Okay. Any other answers? Yeah.
One is you can give an overview of the entire market, like whether how the market is performing essentially all sectors and a few larger stocks.
How do you decide that? Yes, yes.
Not sure about how they go about it, but
What he said is
market.
that Sensex, I'll just answer this, I will explain this. So he said that Sensex makes sure that it gives you a glimpse of what's happening in the market, right? Which sectors, which companies are doing well, and then they become part of it. I asked him, how does that happen? You were asking something, but based on market cap. Anybody knows what is market cap here? Apart from I think 2-3 guys who know. Other guys, if you want to make an attempt, what is market cap? Market capitalization? Yeah.
Number of shares times the price.
Number of shares
Times the price.
price. Yeah. So number of shares, okay, multiply by the price of the stock. Basically, what is the equity? That's also called equity capital. That's also called that's not equity capital. That's actually market capitalization. That means if I have 1 lakh shares issued in the market, if I multiply that with the price of the stock, that's actually called the market cap. Okay, market capitalization. Okay, so as per whatever these 2-3 gentlemen have told, the bigger market capitalization company come into an index. Why do they become bigger? Sorry? Why do they are, so he's saying they are traded the most. Why are they traded the most?
Trust them, I guess. Like
Trust. Any guesses?
Investors see potential in those stocks.
Potential, okay. Okay.
These are comparatively safer investments.
Okay. Anything else? Parth, any? Yes, yeah.
They're in trend or demand. Then trend or demand.
They're trend and demand. Okay. Why they are in trend or demand? That is my question. Somebody said trust here. Somebody said, yeah.
Their growth prospects are boosted due to some event. Their growth prospects are boosted due to some event that would sort of give them an opportunity to expand or, sort of get more.
Okay. So I'll make your life simple. So all these questions are part of that question, that answer. So Ashoka is building a new tower there, the new campus there. And if I launch a next residential tower next to it, okay, so I'm gonna pitch my residential tower saying that because the new campus is gonna come, okay, there will be a lot of demand. So what will happen? The price of my real estate will go up. Potential to make more returns. If I'm investing in a particular stock, okay, the potential, that means the company is gonna make money for investors, for themselves, or for their business is gonna do well. Okay, they must have done well, and they are expected to do well. So there is an interest. So I buy it because of me. Then Shams also see, okay, I have done, so my colleague Shams, he buys it. Then Parth buys it, okay, and then so on and so forth. If and because all these companies declare their results on quarterly basis, if I continue to do well, my share price will continue to go up. Share price will go up, that means what will happen? The market capitalization will go up. End of the day, if company is making money for themselves and for investors, there will be a lot of interest. Okay, So all those companies who are making money for their investors consistently, and they are also large market player, become part of index. That's why it's also called replicate the market. Now to answer your point which you mentioned, just it replicates market. It gives you glimpse of what's happening in the market. It also tells you, if you look at US S&P 500 you just mentioned, any guess which is the biggest sector in that index? Technology. If you talk about Nifty 50, which is the biggest sector in India? Largest sector?
Steel.
Steel. Banking. Okay. Now look at, that's a developed economy. So they don't need finance now. What they work on, and they work on more technology. So technology companies are bigger. India is still a developing economy. We need banks. We need a lot of money. Banks and NBFCs are actually backbone of an economy. Okay, and these companies, that's why you have a largest weight in the index. So that talks about where your economy is heading towards. Right. So S&P 500, you will see tech first, hospital second, and third financial. What we see today is financials first. Okay, then we see consumer discretionary, then we see IT, then we see hospitals. Okay, so whichever companies do well actually become part of the index. So you are actually buying the market wisdom. I am just staying this point to market wisdom. I'll come back to you again on this point and this word. Okay, so let's understand what an index and what an index fund does. So there are 30 stocks. Here you have taken an example of 10 stock portfolio, the Nifty 50. So this is an index. Index is an Excel sheet which an index committee issues time to time. Here we have taken just to fit in the screen only top 10 stocks. And the job of index fund or ETF is to just replicate this. Okay, so when I say a passive approach, I am just replicating that Sensex or Nifty 50 in the same weightages. That is why I don't need research base. But there is one point still remaining, which is market wisdom. I'll touch upon it. So, but what happens is I cannot exactly copy all the stocks in the same weightages because this is an Excel sheet. In the capital market, I can't buy fraction stocks. So sometimes some weightages are different. Here is 3%, 2.9%. Okay, so exactly I cannot replicate, but this is more or less you're very, very close to an index. And some fraction percentage and some cash component. Okay, so this is what exactly an index fund or ETF does. It replicates an index. Why it is important? What are the benefits of investing? First of all, easy to understand. You know, if I talk about Sensex 30, if I talk about Nifty 50, top 30 stocks of Indian stock market falls under the Sensex. Top 50 stocks Indian capital market falls under Nifty 50. Right? They are the largest companies. We just saw some of the names in the previous slide. Anybody has objection against any of these companies? I don't want to invest my money in these companies. Something like that. They're all not only big companies, but they are actually MNCs. Okay, they are global players, not only in India but abroad also. Okay, so all bigger companies will fall under Nifty or Sensex. Very easy to understand. If you don't understand, this replicate by an index. So that's easy. Economic, because we don't have fund managers, the cost is lower. Okay, we'll talk about that also. And effective is what you need diversification, asset allocation also. But importantly, couple of numbers I would like to highlight here. Any guess how many PAN numbers we have in India? Aadhaar.
Maybe
1 crore. What's the population? 150 crore.
Around 60 crores.
Too low or too high? Just guess. Okay, any other number? 100 million, 50 crore. Yes, so that's the number. Yeah. You have any other number?
175
148 crore तो अपना population है.
plus
बाकी
HUFs
जो
and
घुस बैठी है
companies
उनको बाहर रखेंगे. Lighter note. Yeah. So 175 is what? 1 crore 75 lakhs. No, it's actually around 50 crore. Okay. And how many people invest in mutual funds?
2.5 years.
Okay. और कोई number? He had some different number. Okay. You want to share that? What's the number?
Not sure.
So today we have, yeah,
But or less than.
less than 1 crore. Okay. 3 crores? 3 crores. Okay, so today we have 5.4 crore people investing in mutual funds. You know, in 30 years of history. Any guess how many demat accounts we have in India? 6 crore?
8 crore.
8 crore. Any other number?
20.
20?
10. 10.
10, 12. So 12 crore is the right number. So slightly less than 12 crore. How many Dream 11 users in India?
1 billion.
Sorry? 1 billion. Any number?
80, 90, 20 crore.
So they are actually more than our PAN card. Okay? A structured portfolio have 5 crore. A trading portfolio has around 12 crore. And Dream 11 has more than 3 crore. Okay? See how are we investing. Okay? We don't have, I think we just crossed, Jan Dhan also crossed, the bank account also was at 50 crore number. So there is a problem here because structured portfolio has not been understood and has been sold. Because structured portfolio mutual funds are also becoming complex. There are more than 600 equity schemes. Right? And everybody has a different styles of investing. How do you choose? That's where easy word comes into picture. Top 50 companies in India. My life is simple. If investment is not understood by my mother and my maid in the house, you know, the Dream 11 number is gonna go up further. Not the mutual fund. Because she understands something more there which she doesn't understand in mutual fund. And that's where passive index funds or ETFs will help. Buy a simple portfolio. So I would not tell my mother, मामा आपका पैसा जो है ना इंडिया के सबसे बड़े 50 कंपनी में लगने वाला है. My pitch is over, right? बड़ा chances she will say no. You know, if I have to tell her, you know, I'm going to invest your money in some growth companies, quality companies, you know, which have low PE, high PB, or whatever, blah blah blah, high growth rate, high ROE, तो बोलेगी thank you. तो ऑफिस में अच्छा था करके, right? So we have to make life simple, and that's a job of ETF and index funds. It will make your life simple to reach, to understand. Okay, so we are not dwell into the world of ETF and indexing today. Okay, you will hardly hear such detailed session. Okay, I would recommend you this recording is where we should send it to each and every student of this college. This is a very different perspective and a very serious discussion we're also going to have. 5.4 crore versus 54 crore of Dream 11. Right? So the solution is this. Now coming back to passive funds, there are two types of passive funds: index funds and ETF. We are going to talk about more about ETFs today. Okay, but index fund and ETFs are similar. Portfolios are similar. Difference is ETF is like a combination of So ETF is a combination of a fund and a stock. Okay, that's why it's very popular. So you need a demat account here. You're not buying one stock, you're actually buying a portfolio of stock, maybe 10, 15, 50, 100. Okay, it's a portfolio, and also like a stock you can buy real time. If 1 o'clock market falls, you will be able to buy and capture that price. 3 o'clock market rises, you'll be able to sell Nifty 50 at that price. So it's a portfolio which you are trading. Okay. So that's the difference in ETF and index funds. ETF is basically, again, it's like a stock. You need a demat account. Here you don't need demat account compulsorily, but you can also have all these units in demat account. Okay. What do you get a real time NAV? Here you get end of the day NAV. These are the top 15 securities traded in US stock market. Look at their volumes. It's more than 400 million. This is on a particular day. This is 6th of October. Look at the last stock, 15 stock, 106 crore, 102 crore. Okay. The next slide talks about the top 15 ETFs traded in US stock market. The number 15th stock was trading at volume was 102 crore. The number one ETF is trading 100 crore, 100 million. What does this talk about? This talks about that people are actually moving from individual stock to portfolio. And the most transferred portfolios are ETFs. The number one currently is a spot silver ETF. Then we have Bitcoin, Ethereum, S&P 500, Spider. The first ETF which listed in 1993. We'll talk about that history also. This is US. Let's look at India. Top 15 securities as of Friday, which is 10th of October. The number one is 2,700 crore, and last is Reliance 800 crore. This is INR. That was dollar. Top 15 ETFs. Number one is 1,000 crore. Okay, this is in silver. Then you have gold Bs, which is gold ETF, silver, liquid SJC. So what I'm trying to say is the top 25 stocks have actually securities include a lot of ETFs. So it's not only in US, in India also this is becoming very, very popular, very important. If I just take you back to what's the history. So this is how the history of investment or portfolio investment happened. The first investment portfolio closed-ended started in 1924. Okay, first mutual fund, official registered. Okay, then Investment Act came in, and then a lot of theories, including Pharma and Sharp efficient market theory came in. The first index fund was launched in 1975, which was on S&P 500 US by Jack Bogle or John Bogle. And first ETF was launched in 1993, again in US. It's S&P 500 Spider. Its name was Spider. And then a lot of evolution happened. Nasdaq, you must have heard, and Nasdaq was launched in 2000, which is the IT index. Why is this happening? Why people have seen shift? First of all, people want to actually move from individual stocks to a portfolio, because portfolio has lesser risk. Events like Satyam, WorldCom, and Enron, when you have a particular security, chances of losing are more. At portfolio level, this doesn't happen. Because portfolio they rebalance frequently every 6 months or so. Companies are becoming complex. You don't understand what's actually mentioned, because audited balance sheets also you don't know what's coming out. But index funds and ETFs actually make your life much simpler. Again, people wants to move from individual stocks to a asset allocation. I just don't want to buy stocks. I want to buy a portfolio of stock. I want to buy a debt portfolio. I want to buy commodities. I also want to buy real estate. Okay. I want to buy alternate investments, which is EIF. Okay. So the asset allocation is actually becoming more important than just buy particular stocks. These are some of the examples of what kind of ETFs are available, from global to country specific to cash specific, currency, commodities, etc. Let's understand the arithmetic of index. Very important. Nobel laureate William Sharp talks about this. A portfolio return is always a market return minus expenses. And there are multiple expenses what you end up paying. And that's one of the reasons why a lot of actively managed funds tend to underperform. The cost eats you like this, like an iceberg. Okay? There are a lot of expenses that we see above water. These are only called management fees. But there are a lot of costs under water, trading commission, bid-ask spread, market impact cost that affects your portfolio. And these are least in ETFs? Just a guess. If you save 1% expenses over long term, 25 years, what do you think? How much your portfolio would look like? How many your portfolio would reduce? You're paying 1% more expenses over 25 years. Any guess? 30%. Anybody? Yeah, so you are very close. 28%. Humongous, 15 lakhs. If you say if your portfolio would have grown at 12%, just 1% expenses, 15 lakhs to 11.7 lakhs. This only I'm talking about the expense ratio. There are a lot of other expenses which we are talking about. These will actually erode more your portfolio. So what we have observed is, these are some of the active mutual fund schemes in 2010. The top 5 funds ranked. 10 years down the line, none of these featured in even top 50 or top 25 also. Right? Yeah, there are some of the are there in top 50. The consistency, the cost plays a big role. Okay, and that consistency is actually affecting. And why this is happening? In fact, there is one more data I got from S&P Dow Jones PIVA report that in 2015 there are 1,000 schemes, active mutual funds. After 10 years, which is 2025, only 336 remain. So almost 630, 670 schemes shut down. This is an active mutual fund document. It's called survival bias. And this is what Spiva talks about. This report is available freely. This talks about how the underperformance, why ETFs are becoming popular, how many funds, how many active funds are underperforming in each continent, whether it is US, Canada, Chile, New Zealand, India also. Okay, against a particular index. So 1 year, 3 year, and 5 years is the number, one period. So there are a lot of funds are actually underperforming an index. This is across caps. Again, same thing. This talks about the underperformance. So let's understand why this is happening. What do you think the potential reason of active fund underperformance? How many of you know driving here? Car driving? Okay. If you don't drive for next 1 year, what will happen? Will you forget driving? Because that's a skill which you acquire. A portfolio fund manager, an active fund manager, if he has delivered a return, why he is not able to deliver it again? That is something also can be considered to luck. Sometimes he was lucky to pick up a stock, pick up idea, and that worked well. Increase market efficiency. Now I'll come back to hear about market wisdom. 1993. Okay, how many mutual funds were there? So 4, 5 mutual funds. Today we have more than 40 mutual funds registered. Okay, sorry, 50 mutual funds registered, and the 45 plus are active, live running. 1993 market was like an SSC classroom, 10th board classroom, where how the results would look like. Some students will fail, some students will come in merit, right? Today's market has become like an IIT classroom. You have more than 1,500 registered fund managers with SEBI. You have analysts, thousands of analysts. Okay, you have thousands of institutional brokers, institutional investors, hundreds of insurance companies, mutual fund companies. Your classroom has become like IIT classroom. What will happen? Okay, say number 1 student in IIT classroom, maybe at 98%. The last student in IIT classroom will be what? 90%? Not even 90, less than 95%. This is exactly what has happened. Market efficiency has increased. Any information which is available to this corner or that corner in today's market is similar. When market efficiency goes up, your portfolio is managed by, you have to compete with IITM and not just another inefficient market. So 1993, the alpha means market return and portfolio return used to be like this, huge gap. Now your market has actually come here. Since your market has come in here, now you have to outperform from here. This becomes challenging because you are competing with another IIT. Change in fund manager. Fund manager is doing his job, right? If he is not happy after 5 years, 10 years down the line, he leaves. And you have invested your future looking at that fund manager, but he is no longer. And his style, he might go from growth to quality to value. That also affects the portfolio and high cost. These are some of the things that actually affects the performance of the fund. Let's look at some of the investment gurus, Nobel laureates. They talk about passive investing. It's very clear. If your salary depends on to do something which you don't have to understand, that Upton Sinclair, then William Sharp, the laws of arithmetic have been suspended for the convenience of those who run their life as active management. Such a strong statement. Warren Buffett keeps talking about this every year in his financial report, his annual report, that index fund, less of expenses, will do much better job than most of the active funds. Those who don't have time, those who don't understand investing, should invest in index funds. Investment guru Peter Lynch, all throughout life, he was an active manager. His entire life, he outperformed S&P 500 index. He have delivered more return than S&P 500. Last 3 years of his retirement, he could not, and then he started saying this. Because market efficiency increased, and he said, now you can't outperform S&P 500. Peter Bernstein, is again, the luck and skill is seldom apart. Your skill can be repeated, your luck cannot. And finally, Benjamin Graham talks about the portfolio management is the management of risk and not about returns. We only run behind returns, and that's why most of the people fall trapped in the individual stocks and not in the portfolio. Yeah, let's come to ETF. Let's understand what ETFs are all about. ETFs are nothing but a stock, but it's also a mutual fund. We just saw a stock of 50 portfolio, stock of 30 portfolio. It's a combination of equity, stock, and a fund. This is very interesting now. Let's understand how ETF gets traded on the exchange. Okay. So this part, if you are trading on the exchange, you know this. There is a buyer and there is a seller and there is a buyer. Right? The trade happens when this price meets. Correct? Somebody wants to buy, somebody wants to sell, then it meets. If there is no demand, there is a demand is high, the supply is not there. What will happen? The price of that particular security will go up. Because of the less liquidity, the demand price will go up. But in case of ETF, whenever this happens similarly for when you are buying and selling, but whenever the price go beyond a particular limit, which is called INF, there is another concept called market making. He is nothing but an authorized participant where he deals with the fund. So fund is here, mutual fund is here. Whenever there is an order here, say he wants to buy 1 crore worth, say gold ETF or Nifty ETF. If there is no seller, market maker will provide those units to you. What he will do, he will come to us, he will actually give us say 1 kg of gold or 1 crore of Nifty ETF, Nifty stocks, and we give him units. Okay, so that's called, he is creating in kind. So he is giving us stocks, so we give him units, and those units are delivered on the exchange. So practically, there is no limit on how much you can buy on exchange. Okay, for a particular stock, there is a limit. If you try to do more volume, the prices will go further up, and then end of the day, the trading might stop for a particular stock. This doesn't happen for ETF. Okay, so this is an additional mechanism of authorized participant, which is also called market maker. So these are actually SEBI's new rule, which is helping market to do a lot of volumes. If somebody wants to buy less than 25 crore, he has to buy on the exchange only. Otherwise, there was time if you want to buy 10 lakhs also, you could come to AMC. It's not like that. Now, if you have to buy less than 25 crore, you have to buy on exchange, so volume increases. If you are buying more than 25 crore, you can come to AIMS directly. And we need to have at least two market makers registered with SEBI to make this liquidity possible. This is how it happens. If you want to buy with AMC, you have to transfer cash to us. We buy ETF units and we buy stocks and give you the units. When you want to sell, again, either if you're more than 25, you can come to us. We will sell those stocks and give you cash or account or fund transfer to you. Let's look at evolution of ETF in India. So the first ETF which happened, this is a company which I worked with. This is a product which I launched in 2007. Okay, it took us a long time to get approval for, you'll be surprised to know, gold ETF as a concept was designed by India. This was by Benchmark Mutual Fund globally. It took us 6 years to get an approval from SEBI. Meantime, using our offer document, this product was launched in US and Australia. So gold ETF became popular globally first, then we got approval. Okay, and then lot of events happened which created the buzz for ETFs. Okay, which is government started investing their EPFO money in ETFs and all. This is what last 5 years growth, almost 45% CAGR. We have seen this again last December number. Now we crossed this number. We are at 12 lakh crore, 12.5 lakh crore of industry. We have 150 plus unique strategies across debt, equity, commodities, and international available in India. I'm talking about strategies unique. Okay, 12.5 lakh crore of AUM. If you want to look at ETFs, these are the ETFs, broad base from Nifty 50. There are so many guys, and so many. Here are the funds. These are the funds, number of funds, the number of ETFs on a particular index. This is the AUM, the funds they are managing. Okay, these are smart beta. We'll talk about briefly what smart beta is all about. Multi-factor, gold and silver. We have 36 ETFs listed. This is the AUM. It just crossed 1 lakh crore now. International also are available in India. Okay, these are the Nasdaq. So we have 200 plus equity ETFs, 36 plus commodity ETFs, 6 international and 38 debt ETFs. Okay. I have one more. These are some of the sector, thematic, and different. This is on the debt side. Okay, so many funds are available: 38, 33, and 53. Just one number from US. Last 1 year, US launched new 781 ETFs. Out of that, 115 launched only in September. Okay, when we look at India, this number, of course, this number is also very high when you talk about India. We have launched 179 of this including index fund ETF, new funds in India. Okay, this is again a large number considering what 25 years or 30 years of history of India. But it's a long, long way to go. Okay, they are launching these funds in 1 month, they are launching in 1 year. How many of you have heard smart beta factors? So far, what we have learned that if I want to buy an ETF, there is an option of Nifty 50, Sensex 30, where I get a market return. Now there are indices which actually give you more return than the market. Okay, and they are nothing but quant portfolios, very very simple quant portfolios, but powerful portfolios, very transparent portfolios. And these are the styles called momentum, low volatility, quality, and value. If you see over long term, all of them have outperformed this Nifty 500, which is the broad market return. Out of that, momentum and low vol are actually very popular globally. Low vol is actually popular. Number 1, number 2 is momentum. What used to happen so far? If you want to buy a particular style, you have to go to an active fund manager. Now these styles are available in passive also through smart beta ETFs. There's an interesting data about correlation. I don't know if you know correlation. Correlation means if equity prices go up, what will happen? The index also will go up. If equity prices go down, the index also will go up, right? But when equity prices go down, what happens to debt? Debt doesn't react similarly. Gold doesn't react similarly, it reacts differently. That's called correlation. How do you behave in a particular event? Okay, market crisis or bull market event. So this lower number talks about you have a low correlation. That is, all these four smart ETFs, smart beta strategies have a lower correlation amongst each other. One thing also observe that smart beta can be used, like momentum can be used in a bull market, where bear market lower and quality can be used, and value can be used in a recovering market. These are some of the numbers. And some more data about how these four factors have done as against the market. Your market, we have taken example Nifty 500. Okay, you can see most of the time, most of the factors are above market. Okay, so far we always hearing that I want to go to an active fund for alpha with factor that's no longer required. Let's skip this. Yes, investor risk appetite is increasing. Though you are listening this for first time, there are a lot of new ideas are actually picking up on ETFs. Okay, like they want, of course, more funds or lesser fees. Next generation is ready to take more risk. So you need more bigger ideas. We have seen a lot of crypto. We just saw out of top 10, 3 were actually crypto ideas. ESG strategies. There are a lot of new strategies they want to invest. Also, if you look at the choices, okay, they want to invest. Those who are investing longer term or a shorter term also, they are preferring equities. Okay, these mutual funds, gold and ETFs and real estate. So mutual fund and equities actually preferred more. So they are ready to take more risk, and that will actually take to launch new products. So these are some of the new ideas which will come up. Okay, where you will see future actually start developing into ETFs. A lot of innovative ideas will be launched. But yes, some of the challenges here: liquidity and spread. Because the market makers and volumes are still lesser as compared to US. So I will touch upon 2-3 more points, and we might open up for questions. One is INAV. So for stocks, there is no reference price. The demand and supply will match the price. But for ETFs, there is something called INEV, indicated NAV. So this is available on the website, and the trade happens around this price. It's a fair price. That's called INAV. Some of the big things, tailwinds for ETFs growth in India, which I'll cover very briefly. First of all, ETFs started investing in 2015. That actually gave us a lot of flows in ETFs. Categorization happened in 2017. TER, Total Return Index. There used to be price return index. Dividend used to not be part of the index. That got added in 2018. COVID-19, fintech took stock market each and everybody's hand. That was another disruption. Gold souvenir bonds. I don't know if you heard this gold souvenir bonds. Government launched this idea, saying that you give us money, we'll buy gold on your behalf, we'll give you interest, 2%, tax-free interest, and we'll give you the gold price whenever you redeem, or it's a 5-year or 7-year product. That stock, so gold ETF, silver ETF started getting good flows, and we just spoke about 25 crore minimum investment. That also helped in increasing volumes. 2 more topics: tracking difference, tracking error. So when you replicate a portfolio, you can't replicate 100%, and that causes tracking difference because of expenses. Okay, And you can see there is a fund which has a higher, fund A has a lower expenses, fund B has a slightly higher expenses. But when you manage on a daily basis, there are a lot of instances happen, and when you look at the consistency, this consistency is called tracking error. It's nothing but a standard deviation. You understand maths? Standard deviation of your errors is called tracking error. Okay, so lower the tracking error, lower the tracking difference is better for investing. And some of the myths I will cover up and will stop. That ETFs are volatile, but they are actually not, because they are the portfolio. It's not the individual stock which you buy. And their price is also transparent. We spoke about INAV. ETFs are inherent risky. In fact, individual stocks are more risky because here you are buying a basket of stocks. ETFs only apply if you are investing in a very specific piece of the market. So it actually offers you all the pieces of the market. If there are cement index, there is a cement index available, energy index available, oil index available. Okay, but you can also buy the broader index. You know, I can buy Nifty 500. The way she spoke, S&P 500. I can buy the 500 stock portfolio, 750 stock portfolio, 1000 stock portfolio also. ETFs are actually not income for investors since they don't pay dividends. It's actually not. There are dividend paying ETFs are also available. And ETFs are just for day traders, actually not, because the expenses are so low. Not only management, the actual impact cost also. A long-term investor can build their portfolio around ETFs. We'll talk about some of the risks of the ETFs. Advantages we already learned. So of course, if ETF like a stock market, you know, you're actually investing, so capital risk is definitely there. Tax risk depends upon which product you're getting into, debt and equity or debt and equity and gold. Currency risk if you're getting into another country. And liquidity risk is something very, very, very important, where you know if your ETF is not liquid, you end up paying slightly more price. So that's all. Again, I'll end with what Warren Buffett says. Okay, low cost investment. Benjamin Graham was actually mentor to Warren Buffett, who wrote the Intelligent Investor. If you have not read this book, you must read this book, The Intelligent Investor. Okay, he was the guy, Benjamin Graham, who taught value investing for the first time, 1980. Security analysis, security investment. Just forgetting that book name. You can actually, he wrote in 1980. Okay, he actually taught the word about value investing, and he was mentor to Warren Buffett. As he said, if you understand mathematics, if you understand market efficiency, okay, index funds and ETFs are simplest option one can choose. So that's all from my side. Any questions if you guys have, would like to take up?